Hello everyone and welcome to the channel. Today I want to delve deeper into PayPal and why I decided to double down on on my current position. So it's a company that has been battered as far as stock price is concerned. This has been the case for the last several years. Let me start by showing you a chart to see exactly what I'm talking about. First of all, let me put this correctly. PayPal. All right, here we go. Now look at this chart. If I go back, zoom out, max, look at that. At one point, not long ago, 2021, the company was trading at a high of $308 per share, and it's now sitting at $60 per share. Yeah, it's a big crash, isn't it? And so you're probably asking, why did I decide to make an investment here? And why now instead of earlier? Well, the reason is I was never very fond of of previous management. They were doing a lot of things that, in my view, were destroying shareholder value, and so those things kept me at bay. And one of the things were, for example, we can talk about. I'll talk about this in more detail. But one of the things they were doing was they were growing revenues at the cost of margins. Essentially, they were growing revenues, but without necessarily improving profitability. And that's one of the things that really I didn't like because again I'll talk about this better going forward. First of all, let's start with the very beginning. Let's start from the beginning. You already know that I follow a list of 15 questions, and then I try to answer each of these questions. And then what I do is, irrespective of which business I'm analyzing, I try to rate the business on each of these metrics that I like to follow. So one of them is, do I understand the business model? If I can't understand how the company makes money, then I would make any investment, right? And sure enough, you can see that PayPal started as a global payments provider, but right now with the new CEO, they are trying to pivot to e-commerce. And so they are a lot more than just a global payments provider, but they do provide services to merchants and customers. And I think this two-sided, as you see here, this two-sided platform is one of the biggest competitive advantage, because they by doing this and by leveraging their user base, which exceeds 400 million active accounts across 200 markets, they can then they can use the data, right? They can collect the data and then create better, innovate, create better products that will create more value to these users on a daily basis. And I think that's one thing that I really like about PayPal. And so how does the company generates money? You can see that about 90% of its revenue comes from transaction fees. So these are PayPal acts as processes transactions on the back end and then collects a fee. Merchant fees, right? For example, is the first one. They charge merchants a percentage of the transaction value. And then, of course, we also have cross-border transactions. When you send money to somebody else abroad, PayPal charges a fee. So most of their money derives from these things. These are called transaction revenue. It falls into this category. And then there is the value-added services, which represents about 15% of their total revenues. And this includes things like referral fees, subscription fees, gateway fees, and partnerships. Yeah, for example, PayPal earns interest on customer and merchant balances held in its accounts. Subscription fees, right? So revenue from invoicing tools. These are features that are built into PayPal's ecosystem, and every time you want to access them, then you have to PayPal will charge you a fee. In this case, it's a subscription fee. And then, of course, currency conversion and withdrawal fees. When we try to withdraw money from our wallets, that they charge a fee as well. So this is essentially how the company makes money. And you can see that transaction revenues and value-added services, you can see the percentages have been quite consistent over the years, right? So, and yeah, as far as the client base is concerned, this is something that I like to analyze as well, and I did that here. So the geographic split, where does the company generates most of its revenue? You can see that 55% comes from North America, whereas 30% comes from Europe, Middle East, and Africa. So you can see they are well spread across the world, which is something that I like as well to see. And yeah, so in clients, so we already mentioned consumers and merchants, right? And this is something that I like because they have data, they can collect data from both sides, which provides with a very strong competitive advantage, especially when they leverage the over 400 million users that they have. Okay. Now, is management capable? Let's delve deeper into management. So I was telling you that I wasn't happy with previous management, and the reason for that is they were, number one, as I told you, they were first of all, they did a lot of acquisitions, and I don't think those acquisitions, some of them for sure, are not going to create shareholder value over time. And when an acquisition is when there are not enough synergies, that can end up, it destroys value over time. Okay, especially if PayPal pays a lot of money for those companies, and yes, so they were doing a lot of acquisitions in hopes of growing their revenues without necessarily creating substantial value for the business, and that's a big red flag for me. And sure enough, revenues were going up, but profits were starting to, and margins were getting squeezed. And you can see that, for example, if I go here, let's go to metrics. Chris took over in 2023, and you can see that we are now on the way up again. But since 2015 all the way to 2023, gross margins have been declining. All right, even though revenue was improving as well, and so that was a red flag. Look at operating margins again. So they came down since 2017, big red flag. But now, ever since Chris took over in September 2023, they are on the way up. And the same happens with, for example, net profit margin. Look at this; they just crashed, right? But now they are once again back up. So I like to see this. I like to see that the business is improving, is becoming more efficient. It streamlined its operations, and that's part of the strategy pursued by the new CEO Alex Chris. And another thing that he's doing is so he wants to create. He believes PayPal should be at the forefront of innovation, and it needs to be fast in terms of how well and how quickly they can create these features that are going to create value for both customers and merchants. And failure to do this will allow competition to breach their moat, which is a big red flag. So he understands that, and this is something that I really like to see. Like I said, it's a highly competitive environment, and if you fail to innovate, you are going to get crushed by competitors. Okay, so this is it. Something that I wanted to see. Another reason why I didn't like former management is because if I go to cash flows, you can see. In fact, let me go here. You can see that these are cash flows, stock-based compensation. Take a look at this. This has always been a red flag for me. Typically, you will see tech companies, they do have compensation levels that are high because they need to attract and retain talent, right? So if employees, you can compensate them with big salaries, but at the end of the day, they will want shares in the company. And if you are the CEO, it makes sense to have some shares, to share some shares, because you are creating an incentive for them to work towards the company's goals. Because if the company does well, they will get more compensated, right? So their interests are aligned, which is okay. The problem is when you are using too much stock-based compensation, and that was the case of PayPal. And so it had exploded higher since 2023, and now ever since Chris took office, it has come down, and I would like to see some of this continue, right? So I would like to see it stabilizing at lower levels, and that appears to be the case, which is a big positive. So I like the CEO. Yeah, you know that. I think this guy, he comes from Intuit, and he has this is his first time as a CEO, and so he has a lot to prove for sure. Especially when considering that he's at the helm of a company as large as PayPal. But if you look at his track record, he's done amazing things at Intuit. He has driven revenues and profits substantially, and I think he can replicate the same success in PayPal. So the one thing that I would point out, though, is that insiders only hold less than 0.23% of outstanding shares. I like to see this at 8-9%. So it's not perfect, okay, but if I go here to insiders and you see ownership, and let's show you only a company executives, you can see that Chris has about 6.5 million. Yeah, so this is the total value, right? It's the ownership. That's the total value of his shares. So I think it's substantial considering his salary. And I think, look, I think his interests here, he has some skin in the game for sure, and he's aligned with long-term shareholders. So I like to see that, even though preferably I would like to see higher insider ownership. Okay, so we discussed this, and now, does the company have a sustainable competitive advantage? I don't invest in companies that don't have what's called a moat, a competitive advantage, and in my view, PayPal has what's called a network effect. So, number one, everybody knows PayPal, right? If you don't have an account with PayPal, you might know someone who uses PayPal, right? And so they are globally recognized, but this is it, guys. So they have 400 million active accounts across 200 markets, right? And the reason this provides for a network effect is because as more users adopt PayPal, merchants feel compelled to accept it, further increasing user adoption, which in turn leads to more customers, which in turn leads to more merchants. That's how powerful this is. And when you have 400 million active accounts, there's a lot you can do here. There's a lot of data they can collect. And one of the things they are doing as well is they started advertising. So they want to leverage all these users, in all these all their customers' info to, and they want to start. They want to allow merchants to do target advertising. And I think that creates a very strong value proposition. And yeah, so two-sided platform, of course, I think that's definitely the biggest, the strongest competitive advantage they have, on top of all the integrations and relationships they've built over years. You know, I mean, PayPal has been around for a long time. It was one of the first companies to provide global payment solutions. Okay, and some of these relationships include even relationships with competitors, with the Shopify, for example, and the partnerships with Apple Pay. So yeah, which are competitors, but you know, it shows you that even though they are competitors, there can be some synergies between them. And then, of course, we have a technological infrastructure and security and product diversification. Okay, look at this. Global payments market share. PayPal, 45% market share. Stripe comes second, only with the 70% market share, which, by the way, decreased this or last year, if I'm not mistaken. Okay. Is the company active in attractive end markets? Part of the reason, and this was a very important reason that led me to delve deeper into PayPal, was because I knew that PayPal was operating in a very attractive end market. It's a market that is projected to grow at a CAGR of 15% through 2030. And PayPal, as the leading provider in this space, yeah, can definitely capitalize on this growth. Yeah, especially with the new team, a new management at the helm, and the new strategy in place. I think they're going to be one of the major beneficiaries of all this growth. Okay, so yeah, so it's definitely a secular trend here. Now, what are the main risks for the company? As with any investments, there are risks that we need to consider. The first one is competitive pressures. And that's part of the reason the stock has fallen so much over the past 4 years, is because competition in the space is intensifying with Apple Pay, Google Pay, Adyen, Stripe, Square, all these payment providers are coming in. The barriers to entry are fairly low. Okay, so, and because margins in this space are very high, that attracts more competition over time, and PayPal needs to continue to innovate consistently, otherwise it will be left behind. Regulatory and compliance risks. Okay, this is the case. PayPal deals with um, so does is involved in processes transactions, and so there's a lot of regulation in the field of fintech, and PayPal is subject to all these regulatory pressures that are rooted in the nature of the industry itself. Then, of course, cybersecurity threats. One of the things I like about PayPal is that the platform is overall seen as very safe, even though it's very exposed to cybersecurity risks. But customers like it; they think it's safe, which is something that I really like to see. And other risks, of course, include the geopolitical risks, execution risks. Maybe now with the new CEO, this is probably one of the big ones. What if the strategy that he's implementing doesn't work out well? That's always the case. But that's why we want to invest with a margin of safety to account for these risks. And I think the valuation that PayPal currently has is very compelling. So yeah, does the company have a healthy balance sheet? This is very important. There are a few things that I look for in a solid balance sheet. I want low debt. That's the first thing. And what do I mean by low debt? Ideally, I want the company to be able to cover all its debt within 3 years of current earnings and free cash flow. And that's certainly the case. So you can see debt to free cash flow is 1.75, debt to earnings is 2.86. I like this. Look at the current ratio. This is current assets minus total liabilities. So this means that PayPal current assets exceed its current liabilities, which by 26%. So this is a sign that the company can meet its short-term obligations, right? So it won't face any liquidity issues in the short term, which is very good. And then, of course, I like the interest coverage ratio to be well above 8, preferably. In the case of PayPal, it's 14. It means that the interest coverage ratio, you do the operating income divided by interest expenses. In this case, 14, which means operating income is over 14 times higher than its interest expenses. One of the things that I would say, now that we are on the topic of debt, is that PayPal used to be debt free. All right. And one of the red flags with the company initially is that, let me show you this here, financials. Where is it? long-term debt. You can see it right here. Look at this. Until 2019, the company had no debt. All right. But then from 2019 onwards, that just exploded. And you can see it right here, right here. So much so that the company is no longer has a net cash position, and that used to be the case. So they have yeah, it's negative, as you can see, and it used to be a positive. They used to have a positive net cash position because they really had no debt, but they increased debt, but that didn't necessarily translate into higher returns on capital, better profits, not necessarily. And that was another red flag. So you can see that while debt levels exploded, returns on capital remained, even decreased slightly over time. So if I show you this here, ratios, and then if I show you returns on invested capital, which is the most important metric in my opinion, it shows you how well management invests its total capital, right, equity and debt. You can see that the return, so ROIs, this it only goes back to 2020, so I need to come here and show you. Hold on. Return on invested capital. Look at this. Remember that debt exploded. I showed you that exploding from 2018 onwards. But look at the return on invested capital, right? Over the ensuing years, it didn't go up. In fact, in many instances, it actually came down, and it had been under pressure until Chris finally took over into September 2023. It appears that from this match, it appears that purely based on this match, we are on the way up. We are definitely improving, and yeah. So what else? This is the free cash flow. So it's a pass, all right. Does the company need a lot of capital to operate? I like capital light companies because I don't like companies that need to spend a lot of their money just to sustain current operations. I like companies that can use free cash flows to grow the business, to reinvest back into the company, to grow over time. And fortunately, CapEx divided by sales, so capital expenditures, represent only less than 2% from sales. I like that as well. And CapEx only represents 7% of operating cash flows, which I like it. I like this as well. So typically, I like the first one to be below 5%, and the second one to be below 10%. So even though PayPal is doing more reinvestments right now to stay competitive and launch new and streamline its platform, make it more efficient in creating new features, still those investments are just a small percentage of their sales and operating cash flow. Is the company a great capital allocator? I showed you ROIs, and that typically I like to see ROIs at or above 15% over time. That seems to be the case, even though right now trailing 12 months ROIs is slightly lower, but you can see that the ROIs, this is a profitable business. So if I go here, current ROIs stands at 11%, I believe. Where is it? Yeah, it's at about 11%. Yeah. So typically, I like this number to be I like this number to be at 50% or higher. But like I said, in PayPal is doing some investments, and I want to see this number coming back up. And I think as PayPal becomes more profitable over time, and continues to streamline its operations, I think we will see higher ROIs in the future. Okay, then ROI has been well above 15% for the past 10 years as well, which is something that I like to see. So overall, the company seems to be doing a good job at allocating capital. One thing I would point out though is that this 11%, I really want to see this go up, and because I want to see a wider spread. Let me explain. One of the metrics that I follow is called the economic spread. And how you calculate it, you do ROIC minus weighted average cost of capital, which includes equity and debt. So it's the cost of capital. And ROIC is 11%. And I looked it up, and I think, yeah, PayPal's weighted average cost of capital is 8%. So if you do 11 minus 8, that's 3%. This means that the company earns only slightly more on its invested capital than it costs to finance it. All right, so it's far from a level that I would consider outstanding, as I typically like this number to be around 8%. To be around 8%, which would indicate superior value creation. But still, I think with new leadership, with things improving, we are on the right track. How profitable is the company? Look at these margins. Gross margin 40%. Ideally, I would like to see this at 50%, but remember, they are upticking. And net profit margin 13%. This is good. In free cash flow margin of 21%. This is how much of the revenue is converted into free cash flow. So this tells me that PayPal is very, very profitable. Okay, it converts a big chunk of its revenue into free cash flow. And one of the things that you need to bear in mind is that PayPal it's a platform, right? It's quite capital light, because once the platform is out there, then you can spread your costs over a larger number of users, and that will give the company operating leverage over time, and that should lead to higher margins as PayPal continues to grow its user accounts and create more value. And and by the way, now that we are on the topic of user accounts, one of PayPal's key performance indicators is exactly that, is active accounts. This represents the number of people that create accounts with PayPal. And you can see that this number has been declining over time. And that has been a big problem. In fact, one of the things that kept investors at bay was the fact that active accounts were actually declining over time, not just stagnating, they were declining. So and of course that's not going to be sustainable over time, even though the transactions the transactions on the platform may be increasing. Yeah, and that's the only reason that partly explains why revenues are increasing, is because current users are spending more on the platform. It's not because new users are creating more accounts and using the platform. Okay, it's because current users are spending more, and that's the only reason why PayPal is growing. But that's not going to be sustainable over time. So we need to see that active accounts are increasing, and you can see right here that they managed to do this. I don't think it will show up here. This is quarterly active accounts, but from 2000, you can see it's right here. Active accounts growth, they grew by 2% ever since. This is quarterly. Yeah, they grew by 2% last quarter, which is something that I really like. I like to see. But let's see if this trend continues or if this is just a one-off event. In which case, that would be a red flag. Okay. So I showed you this, and then does the company use a lot of stock-based compensation? I already talked about stock-based compensation and how I would prefer it to be lower than it actually is, but we seem to be trading lower, which is good. And then did the company grow at attractive rates in the past? I like to see all these numbers trading at 10% minimum. And as you can see right off the bat, that seems to be the case. Okay, so we have this has been a company that has grown attractively over time, and that's something that I like to see. There has been some hiccups along the way, but I think that's part of their journey. And sure enough, that's part of the reason why the stock crashed so much. But right now, I think fundamentals are improving, and I think the company well. I think the runway. I think there's a long runway for growth, essentially from these levels. And so, yeah. And another thing that I like is the fact that PayPal has been doing a lot of buybacks. And so buybacks, if you don't know already, they decrease. It means they are buying back their own shares, so they are lowering the number of shares outstanding. And fewer shares means higher profits per remaining shares, right? So if you are a shareholder of PayPal, and if they buy back outstanding shares from other investors, that means the profits you receive per share become larger, which is a positive because there are less shares, there are fewer shares available, so higher profits per share. You get a higher piece of the pie, if that makes sense, a higher slice of the pie. Yeah. And so if I go to cash flows, if I go to net common stock issued, look at this. This is how much stock the company has been buying, right? They've been aggressively purchasing their shares since 2021. So they understand how undervalued the stock is. And sure enough, in 2020, over the past 2 years, look at this, guys. I'll show you something. I'll go to freeform. Let me take these out. Look at the diluted shares outstanding and look at the past. Since 2022 alone, we only need to go back 2 years and a half, something like that. And you can see that over this short time frame, the company has bought back 12% of its shares. Okay, so at this pace, they are going to be buying a lot of their shares, especially with considering how cheap the company is. This is a lot. This is quite significant. And I think if the companies continue to improve its fundamentals on top of all these buybacks, then I think a lot of value will be created for shareholders. And yeah, which is a big positive. Does the future look bright? So analysts are projecting between 12 to 13% earnings per share growth rate. So this is very solid growth rate, if you ask me. And let's jump straight into our valuations. You know that my valuations are based on three methods that are taught by Phil Town from rule number one. And one of them is margin of safety, payback time, 10 cap rate, which is owner earnings. I will just focus on these two. So payback time tells you how long it will take to get your money back in free cash flow. And ideally, with a big margin of safety, we want to recoup all our investment in no more than 8 years, because that's typically what private investors pay for private companies, right? And so if PayPal, the latest free cash flow is about this one, as you can see here, let's assume the company can grow free cash flows by 13% over 8 years. And if you divide this cumulative figure here by the number of outstanding shares, then we get free cash flow per share around $77 per share. This means that this is the maximum price you can pay if you want to recoup your investment in 8 years, okay? Provided the company can grow its free cash flows at 13% per year, all right? And PayPal is currently trading at, boom, $59 per share. So it's even lower than that, So I'll probably be able to recoup my investment in 7 or 6 years, which is something that I love. I have a big margin of safety here, considering a typical company in the stock market sells for 16 times earnings. All right. And the other one, of course, is the 10 cap rate, which doesn't assume any growth rates. We are simply basing this on its operating cash flow. And then we account for maintenance capex, tax provisions. When I do the math, I get a price of $78 per share. So again, that's the yield. It means that so if you pay $78 per share, that's practically it's a 10% yield based on the company's market valuation, based on the company's market cap. And that is huge, guys. It means you already have a big margin of safety. Okay. So if you think about it this way, if a house costs you 200,000, if the rental payments on a monthly basis, right, provide you with 20K, that's 10%, right? Yeah, it's going to be 10%. So yeah, it's exactly like that. It's the same as you buying a 200K house and then collecting 20,000 pounds every month in rent. And what that does is at the end of 10 months, you will be able to recoup all your investments as you can see here. So this provides for a huge margin of safety. This is the case of PayPal, and that's also why I decided to buy. So I think I bought a great company at a very, very attractive price. And I think there is not much. If I even go to cash flow per share, let me show you this. I'm interested to see this. So book value per share, here we go. So it's currently sitting at, it doesn't, okay. Yeah, because PayPal is a capital light company, so it doesn't make sense to have a lot of to see a big book value. But yes, so look, I just broke down the full investment case for PayPal, and I do hope you've managed to find this insightful. Let me know in the comments if you enjoyed this session. I know it was a long one, but once again, I want to share with you exactly how I go about selecting businesses. And if you enjoy it, just smash the like button, leave a comment as well. It's very important to grow the channel and for me to continue to deliver more videos going forward. And let's see how our investment is going to play out. And next video, we already covered Alibaba. We already covered Ulta Beauty, PayPal. One of our portfolio positions is still pending, and that is Evolution or ABE. So this is the one that we still need to cover, and we will do so in the next video. Have an amazing day, guys.